Welcome all. Welcome to Financial Freedom Program. My name is Samir Bapat, and today we are going to learn about fundamental analysis. Like I mentioned earlier, this is a three-part program. So we conducted the first part last week. Sorry, we are going to cover following points in the three-part. Debt to equity, we already covered in the last week's session. EBITDA, ROS, ROE till ROE. These 4 points were covered in the previous session, Wednesday. I have shared the link to YouTube video where you can watch if you have missed the first part. Now the second part is linked with the first part. So that's what my expectation is, that whoever is joining today is aware about these 4 things. I'll go through them briefly, but not in detail today. How many of you attended last week, or have seen the YouTube video? Can I have yes from all of you if you have seen that last week and you have seen the YouTube? Okay. Attended. Okay, great. So we have gone through this. So we will be briefly 2 to 3 minutes. We'll be going through this. Then we will understand what is P and what is the trap of P. What is the trap which is in which people come and why they come. So that is a trap of P. Sales growth, profit growth, we will be discussing today. Cash flow, debtor days, inventory days, we'll be discussing next Wednesday. We'll be discussing shareholding pattern. So total 10 points we'll be discussing for analysis. So we'll be getting, if you follow this 10 points and if you cross check for before investment in any stock, if you cross check these points, you will have a fairly good idea for investment. Like, it will not happen that you will invest in some stock which will give you heavy losses. If you take care of even this 10 points, you should be good for investing in excellent stocks. That much I can assure you. So going forward, okay, this is fundamental analysis part 2. This should have come first. Okay. Why fundamental analysis? We are learning all these ratios because ratios are created for better comparison among the companies quickly. So ratios, I will repeat. I have said in last webinar also. Ratios are used for quick comparison apple to apple, because there are a lot of industries. Someone is in IT, there is IT company, there is a petroleum company, there is some manufacturing company, FMCG company. So just to have a quick overview between these companies. But you have to remember, you should not use these ratios, whatever I'm teaching, as a standalone. If someone says PE is low PE, don't fall for it, because this ratio should always be analyzed in comparison with peer companies. So if someone says it's a low PE stock, it's a very misused word for trapping the common investor. You will suddenly hear some post, I have not heard nowadays, but mostly earlier it used to come, a very low PE stock, and people get attracted to low PE stock. You should not get attracted simply by this word low PE stock. You should be knowing how much is the PE of the other companies in the same sector. Someone says low PE FMCG stock, so you have to do comparison with other FMCG companies and see whether this low is the normal of all the lows, or this is something special about this company. Even country to country PE ratios will vary, because their economy, everything, it will change. So it is dependent. So any ratio and percentages, ROC, ROE, return on equity, this company is giving fantastic 15% returns on equity. But whether all those companies in that same sector are giving same, or this is one exception, you have to check. All the ratios, what all are shared in the market, are for comparison, But please remember, standalone, you should not compare. You should always compare before taking an investment decision. Compare with the peer group of that industry. What is going on? What is general accepted term? What is low debt to equity ratio? Maybe everyone is debt free in that industry, so it doesn't matter. So standalone, don't compare. Peer group, you have to compare. Is that message clear to everyone? Can I have yes from all of you if that is okay with everyone? Okay, great. Thank you. Now, going forward, while doing fundamental analysis, we should be doing as if we are buying the entire company, even if we are buying one share. Even if we are buying one share for 100 rupees, and if we are investing for a long duration, when I say long duration, that long duration can be anything more than 3 months. For me, within 3 months is a short term duration. If you are in, that has to be done based purely on technical analysis. You don't need fundamental analysis for a short term duration, which is within 3 months. If you are doing anything, investing anything greater than 3 months, comes under long term investment. If you are investing in any stocks greater than 3 months, then even if you are investing 100 rupees, you have to think as if you are buying the entire company. The entire company, you have to make sure that it is worth spending that 100 rupees. Unless until that 100 rupees you have not earned by working hard. Like, it's not your hard-earned money. That 100 rupees, 1,000 rupees, 10,000 rupees is not your hard-earned money, then you can let it go. But if that is your hard-earned money, even that 100 rupees, instead of going and having a soft drink, you are planning to invest in a company, make sure you are doing all the research and thinking, I'm going to buy this entire company. Is it worth investing 100 rupees also? Do the due diligence. So this I have completed annual sales. This I have completed. Okay, so this also completed. Understand profit after tax, earning per share, P, and this thing. Now let's straight away jump to the example of apartment which I started last week. Before I jump into the example of this apartment, just one confirmation: everyone is aware of the apartment, right? Everyone must have bought apartment or seen their parents. If you are a youngster and joining, you must have seen your apartment, your parents buying apartment. So can I have yes if everyone is aware about the nitty-gritties of the apartment buying? Hello, good morning. Can someone type yes? No? Okay. Everyone is aware about the apartment, right? Everyone is aware how to purchase apartment. Many of you must have purchased, many of you must be planning to buy. So I'll take the example of apartment. I'll quickly go through what we have learned so far last week, and we will build upon it our 4 topics for this week. If we are buying apartment, so quickly type yes if you are with me. We have understood last week that if we are buying apartment, so there are 2 components to it. If a apartment is worth 1 crore rupees, then some money we have to bring in. That means the owner of the apartment, whoever is purchasing the apartment, he has to bring in the money, and remaining people take from the bank. So whatever is brought in by the owner of the house is called equity, and whatever is taken as a loan, maybe from bank, from friends, from neighbors, and anything which is taken on interest is called loan, and that is called debt. That is the total capital invested in the apartment. Debt plus equity will become the total capital employed in that apartment. From here we get debt to equity ratio. Debt to equity ratio, smaller the better. If it is small, a bank will give you loan for the next apartment easily. Same is for the company. if the debt to equity is lower, it is understood that you have to repay less loan. So banks are willing to give you more loan for expansion purposes. So expansion will be easier and faster. That is the reason we want debt to equity ratio to be lower. Can I have yes from all of you? If you are till debt to equity, it is clear. You have recalled what is debt to equity. Okay, great. Then let's say I'll just compare. This is debt to equity. I hope everyone has an account, free account in screener.in. So this is the website Screener. Here it is written Screener. I hope everyone has a free login. You can create a login after this program. Go to this, search here, search, let's say MTAR. If we search MTAR technology, we press enter, we'll get this. And then here, you will get the peer comparison. They will give the peer comparison of debt to equity. So I have put this column in this. You can customize it by doing edit column. You can customize the columns. It will tell you what all you want. So you can, let's say you put debt to equity. MTAR, Paras Defense, Anup, Tejo, Skipper. Debt to equity is on an average below 0.1 to 0.9. It is there. So here Tejo Engineering is having 0.64, almost 60% debt. And this MTR is less. So overall, anything between the range of 0.1, 0.2 is good for this industry. That is how we have to compare. Now, then let's say we gave that apartment on rent. Yearly rent for 1 crore property in Bangalore, you can fetch around 4,20,000 rupees as a rent, yearly rent, not monthly. I'm saying yearly rent you have got 4,20,000. Let's say expenses of BBMP tax and all that tax you pay is 20,000 per annum. You reduce the expenses. So whatever is your earning from rent minus expenses, whatever is left is called EBITDA, earnings before interest, tax, and amortization. In a company's parlance, if you see profit and loss, in this first is sales, that is whatever the business they do, this is the total sales. Let's say MTAR has done 573 crores of business in 2023. By March 2023, to do this business, they had material, manpower, all that cost, which does not include repayment of interest and principal to bank, is 419. So expenditure minus, the sales minus expenditure, we will get whatever is left is the operating profit. This is also called as earnings before interest and tax. Once we have this EBITDA, this is divided by the total capital invested. Let's say we had EBITDA was 4 lakh rupees in the apartment, and apartment, how much it costed to purchase? 1 crore rupees. Whatever is the market value is different thing, but the total money put in the business was 1 crore rupees. For after we deployed 1 crore rupees, we got 4 lakh as a income before interest and earnings before interest and tax. So ROC is return on capital employed. Capital employed is 1 crore. ROC is 4 lakh divided by 1 crore. 4% is the ROC. We need ROC more or less? Do we need ROC more or do we need less ROC? Higher the better, correct? Higher the better. More is better. Great, fantastic. So ROC better is more is better. Then for 30 lakhs of loan, we will yearly will pay 3 lakhs of EMI. So this interest gone. So 4 lakh minus 3 lakh interest principal gone. What is left is profit before tax is 1 lakh rupees. Out of that 1 lakh rupees, let's say our business is in 33% tax bracket. So we deduct 33% of tax. So profit after tax is 67,000 rupees. So net we started a business. In the business also, similar thing is done. Sales 573, whatever they may manufacturing, IT, FMCG, any industry. This is the total sales, expenses, EBITDA. Sales minus expenses, EBITDA. EBITDA divided by total capital employed. Don't mistake it for the share price. It is what was the actual money brought in by the owners and loan taken. 154 divided by that money is ROCE, return on capital employed. Then you pay the interest. You take away the depreciation. Whatever comes is profit before tax. Then tax we pay, tax is deducted. Net profit is 104. So this is profit after tax. Once you have paid the interest to the bank and once you have paid a tax to the government, okay, listen to my question carefully. Once you have paid interest to the bank and principal to the bank for this year, once you have paid tax to the government that, okay, this is my profit, this is your tax. Now 104 crore rupees is left out. Will the bank come to you immediately and say, okay, give me money out of 104? 104 crore, give me the money. No, correct? They can't. I have paid your principal and interest for this year. I have paid my tax. This entire money belongs to the owner of the apartment. EMI is paid, everything is paid, 104 belongs to me. Now it is my prerogative, owner's prerogative to do whatever I want to do with 104 crores. Now here in the rent parlance, if you see, after paying tax, everything 67,000 is left. Now this belongs to whom? The owners, the owner of the apartment. So owner of the apartment, how much money he has put? He has put 70 lakh rupees. So at the end of the year, we will see that ROE, how much is the ROE earned? So he had put 70 lakh rupees in the apartment. After paying interest, tax, everything, he is able to earn 67,000 rupees. So ROE, return on equity. Why return on equity? Is because this is the money invested by the owner in the company. This is not whatever market value is there, that is separate, because that doesn't matter to him. He has put in the money, he is getting 0.96% return in this. So return on equity is 0.96%. Here also we want higher ROE or lesser ROE. We want more ROE or lesser ROE? Higher, correct? Absolutely right. We want a higher ROE. So when we are buying a share of a company, make sure, okay, one more thing, I'll say, okay, you should be having at least 15% or 12% is, any company you are investing into, unless until you have some super fundamental analysis skills, till we are a common investor, why I am saying 15%, like a company in which I am going to invest, if you scroll down, it is giving here on right hand side, it is giving last year ROE, return on equity, for last year it is 18%. 3 years and 5 years compounded is 15%. So for 5 years ROE has been 15%. Then ROCE is written here. ROC is written here in the bottom in the same sheet. This company is giving 23%, 16%, 19%, 19%. My personal suggestion, this is only a suggestion. we should have at least 15% of ROCE and ROE, ROCE at least 15 or at least greater than 10% ROCE and at least greater than 10. I prefer to invest in companies who are having greater than 15% ROCE and ROE. The logic behind higher ROCE and higher ROE is I can earn 9% as a from PF. If I'm investing in PF and all, I can get 9%, no problem. I go put my money, it's in post office or PF 8.59% I can get, which is a secure money. If I am taking risk in the market, I want to earn at least 15% from the market. At least 15%, at least it should be worth the effort I'm doing analysis. This that I want minimum is 15, maximum is 100. So if I invest in a company which is not giving returns on equity, return on capital employed more than 15%, or let's put this way, if I am investing my money in a company whose return on capital employed is greater than 15%, return on equity is greater than 15%, how many of you agree that if I buy that share, there is a possibility that share will also grow by 15% at least in a year? Agreed? Yes, no? How many of you agree that if I'm putting my money, if I'm buying a share in a company who's having ROC and ROE more than 15%, then it's a highly likely that the share price will also grow by 15% at least. It grows more also, but highly likely it will grow like that. So that's why we have to filter it out, ROC and ROE. Okay, we are done with ROC, ROE. Then let's say if I am the sole owner of the apartment. Now, okay, now pay attention because we are entering into zone of earning per share and PE ratio, which is very much used or misused in this and very important in this overall analysis. Now, let's say if I am the only owner of this apartment, complete 70 lakh is brought in by me. So number of shareholders is 1. Shareholders contribution is 7 lakh rupees. The contribution is 7 lakh rupees from where the ROE has come. Number of shares is only 1 because I am the only shareholder. So there is number of shares is only 1. Profit after tax is 67,000. So for 1 share, earning per share is 67,000. Okay. Now let's say we were 2 shareholders, me and my partner. We both invested 35 lakh in the apartment. How many shares are there for the apartment? Me and my partner both invested 35 lakhs. How many shares in the apartment? Others, okay. Milind has written something. How about others? Two shares, correct? Hello, only 3 people have answered. How about others? Others have put it on recording and gone. Okay. Hello, good morning, good morning, good morning. Okay, good. Few more responses. So we have 2 numbers of shareholder, 35,000 each. If we earn 67,000, so earning per share is 33,500. If there are 5 shareholders in the company, each has brought in 14 lakh rupees to buy this apartment of 70 lakh rupees. There are total number of shares are 5 in this apartment. Earning is 67,000. Profit after tax, which belongs to the owners, which belongs to the partners, which belongs to the shareholder, is 67,000. So the earning per share will be 67,000 divided by 5, because it will be equally divided among the, it is not divided actually, but each shareholder will have right to decide what to do about the earning. They can put it back in the company, they can take the dividend, they can have a holidays, whatever they want to do. But per share, it is 13,400. Same way, companies have shares, okay, shareholders. So the companies money is divided into shares. That's what we trade on the market. So 104 profit, net profit after tax is 104. This is divided by the total number of shares which are issued by the company, which are held by the proprietors, as well as available for market, in market to trade. 104 crore rupees divided by total shares for the company, you will get earning per share. This is here net profit. EPS in rupees is 33.84. This has come from the profit divided by total number of shares. What is the importance of this number? Earning per share normalizes between company to company. Like if I say, okay, company has earned 104 crore rupees, it is, we don't know whether it is good or bad, but if we change it to earning per share, it becomes normalized. Like EPS will normalize among the companies. So high EPS companies, we will give preference that, okay, the company's earning per share is higher, the better. Because again, this is a second step to ROE, okay, return on equity, and higher EPS is almost same. They have created two parameters. I have not created two parameters. It is created by the analyst and all. They analyze ROE and earning per share. Earning per share will give you in terms of rupees. ROE will give you in terms of percentage. Both are more or less indicating a similar thing. Very slight difference. So don't go behind ROE and EPS. Don't compare both. It is, you can compare ROE or EPS in rupees. Okay. EPS is earning per share, no? So Purvi is asking, repeat EPS. EPS is earning, it's a calculation, right? Okay, I'll come to that again. I'll come to that again, calculation. So let's continue with that. So 33.84 is the earning per share, which is, so compare ROE or earning per share. Now, then why we are learning, why we are wasting our time in learning the earning per share? Because this earning per share is used in PE ratio, price to earning ratio, and that's why we are learning how to calculate earning per share. So except Purvi, can I have yes from all of you if you have understood how we are calculating earning per share? Okay, so Sandeep has given the calculation, Purvi. He is saying net profit divided by total number of shares. Okay. Can I have yes from all of you if you have understood how to calculate earning per share? Okay. Now, once we have earning per share, now let's assume I am having 10 shareholders. Okay, 10 shareholders. Or when we purchase this apartment, for example, let's say 20 se kitna aega? 20. Okay, now I have changed the number. Instead of one person buying this apartment, I am saying taking this apartment as a business. Okay, so let's say 20 people got together, 20 people got together, and we purchased this apartment. Each one brought in 3,50,000 as cash, as equity, to become partner in this apartment. So there are 20 shareholders, and each shareholder got in 3,50,000 as their contribution as a equity to purchase the apartment. Profit after tax this year was 67,000 rupees, and earning per share was 3,350. So each shareholder, his earning, whatever contribution he got in, his earning as per his contribution, that ratio is 3,350 rupees earning per share. Okay. So Purvi, this is profit after tax divided by number of shareholders. You will get earning per share. Now, pay attention. Let me tell you that, okay, this apartment was purchased some 5 years ago by these 20 numbers of partners. This apartment was purchased some, let's say 5 years ago. So 5 years ago, this people, 20 people got together, they gave 3,50,000, they purchased this apartment. Okay. Now, this apartment is in very nice locality. This apartment is of very good quality. This is a very nice locality. It is there. All facilities are there around nearby the apartment and everything. People living in the apartment are very happy. Now in year 2023, if let's say some Mr. X is the owner, one of the shareholders out of all 21, Mr. X is the shareholder of this apartment. It costed him 3,50,000 in year 2018. He gave 3,50,000 and they purchased that flat for 1 crore rupees. This year they got earning per share 3,350. Now in 2023, for that apartment, if I go to Mr. X and say, okay, Mr. X, give me your share of this apartment. I'll tell you, you are a shareholder in this apartment. You are one of the shareholder in this apartment. Give me your share of apartment in 3,50,000 in 2023. You paid 3,50,000 in the apartment 5 years ago. Now you sell it to me for 3,50,000 rupees. Now tell me, will Mr. X give me his share for 3,50,000 rupees now in 2023? Okay, how about others? Will he give me for 3,50,000 rupees? No, correct? Unlikely, because the area is good, the locality is good, there is appreciation in the market. He will say, boss, what you are telling, it was 5 years ago I purchased this. Now demand appreciation is there. There are other apartments going for the good rates and all. Current market price for my share, current market price of my share is roughly 10 lakh rupees, let's say 100,000. Or let's say, to be very reasonable, let's say 700,000, 7 lakh rupees, 700,000. In 5 years, double ho gaya. Okay, everyone, okay, that he invested 3,50,000 in that apartment. Now with the over the years, apartment has appreciated. Now he will say, okay, if you want my share, you will have to pay 7 lakh rupees to take my share, what costed me 3,50,000 5 years ago. Everyone okay? Okay. Now, what is PE ratio is, to me, as a outsider, I'm going and buying from Mr. X his shareholding. For me, for him, earning per share, for him, he paid 3,50,000. In 3,50,000, he is getting earning of 3,350 rupees. But for me, I am buying this share, I am buying out his share at current market price. It will cost me 7 lakh rupees. So if I have to see from my perspective, how much is the earning per share? From my perspective, earning is 3,350 rupees, because I am going to acquire that share in 7 lakh rupees, not 7 lakh. Sandeep, it is not 70 lakh, it is 7 lakh, because his share was 3,50,000. I purchased only share of Mr. X, not other 19 partners. I only picked up the share of the one Mr. X. Okay, it was, his share was 3,50,000. I picked up his share, one of the 20 fellows. I paid him, if I have to pay him 7 lakh rupees, I have to see ki boss ye iska, if I am paying 7 lakh rupees, how much is the earning per share coming? So for me, in 7 lakh rupees, earning per share is 3,350 rupees. So for me, price, what is my price is 7 lakh rupees. What is earning per share is 3,350. So I will divide, okay, 7 lakh divided by 3,350. My earning per share, PE ratio is 208. Price to earning ratio is 208. Now, what is so great about this PE then? Why we are looking at? Because okay, I'll just hide this. I will discuss this later. Okay, because why this is important is, see, I have 7 lakh rupees. Okay, pay attention now. Why this P ratio is important is, this will give me some quick crunching to do. I have 7 lakh rupees in my pocket. Okay, so I'll write 7 lakh rupees here. Now I have different companies in the market, which are shares are traded in the market. Different companies whose shares are traded in the market. Okay, I went to apartment A. I said, okay, what is your earning per share? He said 3,350. So I put 3,350 here. Earning per share is saying 3,350, and one share I can buy for 7 lakh rupees. I put, so my PE ratio, price what I'll be paying to earning per share is 3,350. I get 208 rupees. Sorry, I get PE ratio as 208. Then I go to other fellow. I said, okay, in your company, what is earning per share? Tell me. He says, my earning per share is 10,000 rupees. Okay. So is this more than 3,350 or less than 3,350? More, correct? So if I pay, if his earning per share is 10,000, if I'm paying 7 lakh rupees and the earning per share is 1,000 rupees, has the PE ratio gone down or gone up? For earlier, 7 lakh rupees if I give, earning per share is 3,350. This is the PE. If The earning per share is 10,000. I pay 7 lakh rupees. PE ratio has gone down. If I go to the third party, I say, okay, what is your earning per share? He'll say, my earning per share is 20,000 rupees. So again, this earning per share has gone down. When you are making an investing decision, what would you like? You would like more returns for your money or less return for your money? When you are investing in any company, you would like to have more returns or less returns? More returns. P ratio tells you whether if you are buying the share of this company, how much earning per share that company is doing. So its current market price is 7 lakh rupees. Earning per share is 3350. P ratio is 208. But if the company is earning more per share and if you pay 7 lakh rupees, the P ratio goes down. That's why they say this is a low PE stock, buy the low PE stock. What they mean to say is if you're buying the share, then for the money you are paying, the earning per share for that company is higher relatively others. So low PE ratio is better. But again, caution is this is relative. You should not get trapped. Low PE hai, to buy kar lo. Nahi. You should see ROCE, ROE, low PE, low debt. 4 things you should be at least seeing, because you have to compare and normalize. It is not a digital word ki haan ya naam hai. Koi proposal nahi hai shaadi ka. See, if you are buying a share of company, it's not like proposing for marriage that okay, you either say yes or no. You have to see, even in marriage we see a lot of things, right? It's not yes and no ki boy says yes and girl says like yes or no. You have to see, so you have to normalize. So this is one of the factors. But yes, low PE has a better preference because it tells us that for the money I am paying, the company is likely to earn more. This I have taken the example of TCS. Let me take the TCS and one more window. Let me open. Okay, so let's do some analysis here. TCS and which other company I have taken here? Wipro. Okay, so we have earning per share. This is quarterly profit loss earning per share in rupees is 20.68. This is what company? Wipro. So I have taken, okay, Wipro 20.68 is the earning per share. Agreed? Everyone okay? We have taken this. This is which company? Wipro. Okay, Wipro, we go to annual results, profit loss. Earning per share in rupees is 20.68. Okay, let's take for Tata Consultancy. Earning per share is 31.13. Okay, so we take 31.13. This is the, oh, sorry. This is the, no, this is P, this is PE. Okay, C20. Okay, let me calculate again. Yaar, usme kya hai? It will take one. Okay, let's take current market price. Current market price of TCS kitna hai? TCS is available for current price 3290. Okay, current market price is 3290. Okay, Wipro's current market price is 404. Okay, 404. Okay, earning per share. Tata Consultancy earning per share कितना हो गया? Quarterly results, profit loss, balance sheet. Sorry, earning per share for this is for yearly. Earning per share rupees is 115.19. Okay, so let's take 116. गुड. विप्रो का अर्निंग पर शेयर कितना है? विप्रो का प्रॉफिट एंड लॉस अर्निंग पर शेयर 20.68. करेक्ट. सो लेट्स पुट 20.68. Now we have to see PE ratio. So this is earning per share for Wipro and TCS. Then we see PE ratio. PE ratio is current market price divided by earning per share, and this is for Wipro. So PE for Wipro is lower. Correct? How many of you can see this, that PE of Wipro is lower? Correct. Now, if you want to see apple to apple comparison, like 3290, if we want to, what is the multiple? This is equal to 3290, then this is equal to 3290 divided by 404. 8 ka multiple hai. Sorry, what I am doing. So if we normalize, if we increase it to 3240, this is for 3290, we have 116 rupees. If I have 3290 rupees, okay, if I have 3290 rupees, I can either put in TCS or I can put in Wipro. In Wipro, what is the ratio for this? Okay, so if I put 3290 in Wipro, then how much is the earning per share? I will get 3290 divided by 404 into 20.68. So if I have 3,290 rupees and I have to make a decision to invest either in TCS or Wipro, I will see boss तुम्हारा earning per share कितना है TCS, he'll say 116 rupees for 3290. Wipro, I'll give you 3290. How much is your earning per share? So pro rata basis पे 168. So this is one way of understanding that for our money invested, which company is giving more earning per share, that will come through this way. So this is other way of calculation. So if you have understood the concept, low PE means for our money, whatever is the current market price, for that earning per share is higher. So higher earning per share is better. So low PE ratio is better. Relatively, again, everything is relative only. We have to see what is the PE ratio. So everyone is having around 22 here. If you see TCS, Infosys, HCL, Wipro, and all that. So in that, okay, Wipro is having the lowest, but this is one of the parameters. Then you have to see who is having profit growths, ROE, ROC. So if you see Wipro is having 15 and 17 ROE, ROC. Then if you see others, TCS are having 31, 40 and all, then we will not give that much importance to low PE because other people are having better ROC, ROE. Agreed? So you have to, in fundamental analysis, it's not a science ki pakka batao aisa hona chahiye. You have to balance out, you have to normalize. It's not pure yes and no, that okay, low PE is good. No, theek hai, low PE to theek hai, but what is happening in other parameters, you have to see and try to balance out a normalized parameter out of them. So PE is clear to everyone? PE clear to everyone? Can I have yes to from all of you if you are clear about PE? PE and importance of PE. Why we see for low PE and high PE? Only Milind is clear. How about others? Okay. Okay. Thank you. Now we come to the sales growth and profit growth. Before that, shareholding pattern, I'll go shareholding pattern. Here it is given for our sake of confidence that, okay, people are investing in this company or not. We usually look towards FI and DI. So this is a quarterly basis update. One quick check. It is good to do this quick check. There should not be a drastic reduction in shareholding pattern by FIIs and DIIs in the company. So here, if you see in Wipro, quarter over quarter, 6.58, 6.30, there was some dip, not a major dip. They have increased in March. Here, DIIs have also increased. Okay. Public should not increase. Only DII and FII should increase. If it is increase in public, that means the big players are exiting. So public holding should not increase. Increase should happen only in FII and DII. Then it is good. This is what we have to check in shareholding pattern. So here you see shareholding pattern. It is reducing in TCS 13.5, 13.05, and 9472. No, okay. But DI are picking up. ठीक है, मतलब कोई ना कोई FII DI में से I want a big player to be available there. I don't want everyone to exit. If public shareholding is going down, very good. Public should have lesser and lesser number of shares. More and more number of shares should be with FII DI. Company is decent. Okay. So this is what we have to use for shareholding pattern. FII DI, it should increase or should not decrease drastically. Better if both FII and DI are increasing, it is good. But if FII and DI are decreasing and shareholding by public mentioned here is increasing, if holding by public is increasing, holding by DI and FI is decreasing, stay away from that stock. Public holding is reducing, FI, DI, someone is increasing, okay, still good. Big players are involved in that share. This is how you have to look for the shareholding pattern signals for a stock. Then coming to sales growth and profit growth. Why sales growth and profit growth is important is because if the company decides, okay, I will not increase my sales, I will not increase my sales, I will not go to the new market areas, I will not develop new products, whatever I am having, I'll sell in the same way. Just in old towns, we will have some kachori wala or something, snacks wala, who will sell only one product and he will only sell 50 items only. Then his prospect of growth reduces because someone else will come, he will open one shop nearby him, he will also eat away his market share. And so the prospect of growth reduces if the company decides that, okay, I'm not going to expand my business, not to expand my sales. The prospect of growth reduces, profit reduces. Sooner or later, other competitors will come and eat away your business, and along with your company, share price will go down. So it is important that we have to make sure that there is a growth of sales and growth of profit year over year. So when you are analyzing any company, then there has to be at least 10% year over year profit, and over 3 years at least 20% profit growth, which you will come from here. Like profit variable, sales growth has to be at least greater than 10%. Profit growth also has to be around 10% and more. In 3 years, profit rise should be more than 20%. 3 years, profit variable should be greater than 10 to 15%. Sales variable should be also greater than 10 to 15%. Now, if you see complete balancing of all these companies, LTIMindtree. Okay, now if you see through and through here, we have ROC, ROE 34-42. Do you think it is good? Yes, no, hello, good morning, good morning. Only 2 people are saying ROC, ROE 15%, more than 15%, we are happy. Relatively, it is decent. 34-42, it is decent. Sales growth, see, others are showing, some are negative numbers, some are saying showing less than 10. Okay, LTIMindtree is showing profit growth 91.93, sales growth 117, fantastic. Sales variable 5 years 35.43. So overall, if you see, this PE is higher, right? Because it is growing so fast, PE naturally its price will go up 33.56. But if it's meant, so we can always bring this company in our radar because it is showing good profit growth. So what you have to do is you have to go a little bit deeper in Mindtree, see ki boss, is this a one-off? This year is one-off. कुछ किया है या हर साल they are doing? You should go to profit growth, profit loss, and see. Yes, there is a sudden jump in this year. Okay, but previous years also it has been doing consistent growth from 9 to 10, 10%, 10 to 12, around 20% or 15%. 12 to 15. So consistently, if they have been doing consistently good, this year they did exorbitant, most likely their price would have also shot up. Nahi short hua abhi. Okay, let me see for 5 years, how is their price graph? Okay, surprisingly, their price has not gone up. So people in the group, they can have a look at this, what this company is doing, though the sales has gone up. Okay, profit has also gone up. Looks good. I don't know why the price is not gone up. Sometimes we get to know such companies. Those who are from IT field, they can go further down. They can see the financial report here, analyze. If you find that the products what Mindtree are making are attractive and for sustainable for future, you can further analyze for investing. Okay, number wise looks to be, what is our opinion for this company? We just came across this company right now. As per our parameters, debt to equity pretty normal, correct. Promoter holding is good, 68.68, and then you have profit growth, sales growth is good as compared to others. ROC, ROE, profit variable, and all looks under control. Only PE is higher, which is okay. Sometimes it is okay based on the growth rate. It is. So those who are interested, they can go further deep down. They should go and study the annual report. This is the annual report. Click on this annual report. It will give entire what this company does. It will open everything, what this company is doing, where are this product, what are the market areas, where they are planning to expand, and all everything. Whatever you get in an expert report, you will get here. They make beautiful reports, detailed reports. You can go and have look at this report and see. So I am not saying any other word from this point onwards. So one confirmation, how many of you think that these parameters can really help you find a decent company? Yes, no. All the parameters we have learned can help you in finding a decent, fundamentally good company. Any company you are going to invest or any recommendation comes in the market that, okay, this is a good company. I would always recommend you to go to screener, type the name, see the parameters, see with the peer group what is happening. Now you know the understanding of these parameters. You can decide whether this is good or not so good. And then go to price action, see what price action is telling, and then you can make a decision to buy or sell. Let's do one thing, cash flow. Let's see anything abnormality in cash flow. Cash flow from operating activity. This we'll understand. Okay, 30 profit from operations, receivables have increased, but it is okay. It has the same proportion. No, this is okay. Seems okay. Cash from investing activity, it is okay. Financing activity, they have taken. See, here is one abnormality. They have paid very high, almost double dividend. I like companies which are giving less dividend and reinvesting back into the company, but they have paid the dividend very high. That may be the reason it has not gone very much. But still, if So you have to go and analyze the business prospects. What is this Mindtree does? I am not from IT field, so I am not. I'll also read what they do, but you can go and have a check what this LTI Mindtree does. If you are convinced with their product that yes, their product are required for next 4 to 5 years, or at least 2 to 3 years, then you can plan of doing something about that share. Okay. Okay. So with this, we come to the end of the session today. So let me know if you learned something new, something interesting today. Can I have yes from all of you if you have learned something new, something interesting, something useful which you can use to analyze and find a good stock? Okay, great. Thank you so much. Because of shortage of time, it's already 10. I'll be taking this cash flow in the next and debtor days, inventory days in the next Wednesday. I will answer all your questions once we complete that, because these are some this will not take more than half an hour. We'll finish this and then we'll have a complete question answer session for all 3 sessions. So thank you so much. Thank you so much for joining today. See you all on next Wednesday, and I hope all of you are able to earn a lot of money using this filtration techniques. Thank you so much. Thanks a lot.